Yeah, I think actually finding a good investment manager is a lot harder than finding a good investment.
It is.
So it is a challenge. And I think there's a few things you can look for to try to put the odds in your favor. So one is I think I'd be looking for aligned fee structure where there's kind of a win-win on both sides. I took my fee structure from Warren Buffett where we don't have any management fees. It's only performance fees, and it's after the first 6% every year goes to investors. So there's a sharing after the 6%. The first thing I'd look for is a fee structure that is aligned, which itself would be a stumbling block in this industry. The second is I'd like to find a manager with a lot of skin in the game. So I would look for a large portion of their assets being co-invested alongside me, that not only do they gain from the fees, but they also have upside or downside based on their own assets. So that's the second thing I'd look for. The third thing I'd look for is a relatively young person. So basically, I think we need enough years to be able to look back at a track record, but also enough years so that someone could have a 20-year run thereabout. So probably I would say a mid 40s type age band would actually be ideal, because if they've been in the industry from their early 20s, then you've got about 20 odd years of information to look back on. So the third would be the age, and then obviously the track record of what they've actually done. That would give you some data points. And one more thing I would look for is where do they go fishing? If we look at the US public equities markets, they're very picked over. You have a lot of funds. We have more mutual funds than stocks in the US by some margin, probably more ETFs than stocks. And there's many stocks where they have 30 analysts following them. So what I would look for is what's the kind of game plan to not be fishing where everyone else is. So these are some of the things. And then obviously we're looking for people with high integrity and people that you align with, and who in their past track record demonstrated that they can do meaningfully better than the market without taking as much risk. There's really no special secret sauce to my checklist. I think if you saw it, you might be a little bit disappointed. Oh, it's so simple. But basically, the way the checklist was created was I looked at investments that did not work out for great investors. So this is a relatively easy exercise to do, because in the US, we have 13F filings. So we can tell when somebody buys something. We can also tell when they sell something, and we can come up with some average buy price and average sell price because it's happened during the quarter. So you can come up with approximately what somebody may have made or lost when they sold an investment. So if I have someone like Warren Buffett, for example, it's relatively easy to come up with a list which says, okay, look, these are all the businesses that Buffett invested in that were actually a realized loss in the end, for example. And the question I asked myself is that, let's say US Air was a company that Buffett bought many years ago. And US Air actually in the end did work out because they had a preferred and such. But let's say they lost money on US Air. So the question I would ask, or IBM might be a better example, right? So IBM was an example of what Buffett bought, and actually he had a realized loss on that. The question I would ask myself is, okay, when he made the investment in IBM, what was the thesis, and what was visible or easily visible at that time that was somehow missed by this great investor? And so actually, when you start looking at these companies and asking these questions, it becomes really obvious. And so if I just stay on IBM for a second, what IBM had done at the time Warren bought the stock was that they had published 5-year advance guidance, clearly stating what their cash flows and revenues and amount of buybacks were likely to be over the next 5 years. And I think the mistake Warren made was he relied very heavily on the document. And he had no reason not to rely on that document, because the people who put that document up were very high quality people. They believed the document. They weren't trying to snow investors or something. But if one paid more attention to what was going on with the business, there were some trademarks there that one could look at, and one would have seen that there were some issues there, which later became a lot more significant as they went along. So in that case, for example, there was a very strong, I would say, probability put on the guidance given, and not as strong a perspective on some of these other things that were relevant to the company and so on. And when I did the checklist, for the most part, we could tell relatively easily what was the factor or factors that a great mind had missed. And then we just, the factor that got missed, we just added that to the checklist.
Yeah.
Okay. And once I had all these different factors from all these different investments by great investors, I resorted them by category because they fell into a few different categories. And the single largest reason for investment not working out, when we looked at all the different failures, was leverage. So we have probably about 30 questions related to leverage in the checklist. The second reason why the investment didn't work out was some type of a error or misunderstanding on the moat or competitive advantage of the business. So that was another big category, another probably 20, 30 questions. And the third was something related to the management of ownership, some nuance on that front. And then you get to unions and environment and other things which are more lower down. But basically, the two or three things that really stood out which was the biggest issue. The capitalism is creative destruction, and all businesses are under assault all the time. And so the ability of a business to withstand those constant attacks for a long period of time is more the exception than the rule. And so people tend to misunderstand or misjudge. If we look at a business like Apple, for example, it looks bulletproof, right? It's such a strong franchise and such a strong following, and they could raise prices significantly and people aren't going to switch to Android or anything. There's a very strong loyalty there. When I look into the future, I don't see anything affecting their competitive advantage for 10 years. I think I can make a fairly strong case that it's unlikely Apple goes into decline by 2032 and such. I think it might be cranking till then. But I can't make that statement about 2042. So what looks stable for 5 or 10 years, I have no idea what happens in 15 or 20 years.
Yeah.
And the thing is, if Apple has a real problem by 2037, where it's already gone into significant decline, that's an issue for people investing today. That's a real issue. And these are difficult questions to answer. And that's why I think assessing the durability of a moat is a tough question.